Welcome back to Investing Talk Podcast. Our mission today, well, it's a pretty pressing one. We're analyzing the sportswear giant Nike. We've pulled together the crucial FY 2025 financials, the technical charts right up through late September 2025, and what analysts are saying now. All to answer that one big question. Is Nike stock a good time to buy right now? We've sifted through a lot of material for you, the investor, and we're going to boil it down to the essentials. And hey, if you find this helpful, please do hit subscribe, like the discussion, and maybe leave a comment below. Definitely let us know if there's another company you'd like us to examine in a future session.
Yeah, and when you look at a powerhouse brand like Nike, it's tempting to just focus on the swoosh, right? The history. But really, we have to zero in on the recent performance. And honestly, the last fiscal year, it's been undeniably tough for them.
Okay, let's start there then. Unpack that financial reality because the numbers really do signal a pretty significant slowdown. The contraction is what jumps out.
It really does. What's quite striking is that Nike actually lost nearly $5 billion in revenue last year. That's a steep 10% drop. It brought their fiscal year 2025 revenue down to $46.3 billion. Compare that to $51.4 billion the year before.
Ouch. 10% is huge, and I assume that pain flowed right down the income statement.
Absolutely. Straight to the bottom line. Gross profit fell 14% year over year, landing at $19.8 billion. But, the really critical sign of stress is the margin compression. Gross margin shrank. It went from 44.7% down to 42.7%.
2 full percentage points. That sounds like their pricing power is eroding.
Exactly. That drop confirms it. Their traditional strength in pricing is being tested hard by competition. They're essentially having to, discount more, run more promotions just to move inventory.
And operational earnings, EBIT. Did that follow suit?
Mirrored the pressure, yeah. EBIT earnings before interest and taxes dropped substantially. Went from $5.82 billion down to $4.74 billion for the fiscal year. And this wasn't just some annual anomaly. The drop was very clear late in the year, too.
Okay, so the trend was worsening towards the end.
Seems so. The fourth quarter, Q4 of FY 2025, revenue came in at $11.1 billion. That was down significantly from $12.6 billion in the same quarter the previous year. That's a clear negative path right there.
Right. Now, management did acknowledge it was a challenging year. I saw that. But they're not just sitting back, are they? They mentioned restructuring plans.
Correct. They're pushing forward with two big initiatives, these win now actions, and something they're calling a sport offense realignment. The bet is that these moves can stop the bleeding and eventually return them to growth.
Okay, that leads nicely into their sort of foundational strengths versus these current headwinds. You have to start by saying, historically, they were the leader, right?
Historically, yes. Despite these recent results, Nike has long been seen as the undisputed global leader in athletic footwear and apparel.
Wait a minute, though. If they just lost $5 billion in revenue and sales are dropping in key places like North America and China, is undisputed still the right word? Or is that just a legacy title now? How do you weigh that brand value against such painful contraction?
That's precisely the conflict facing investors right now. Their competitive advantages are undeniably still real. You've got the iconic brand equity, those deep relationships with athletes, and they still run the sector's largest direct-to-consumer or DTC channel. And historically, at least, their balance sheet was always considered robust. Lots of cash, moderate debt, that usually gives flexibility.
But those double-digit declines suggest that flexibility, that cushion, is getting a serious test. Where were the biggest problems felt in FY 2025?
The pain points were sharpest in two absolutely critical markets, North America and China. Sales are shrinking there, and at the same time, competition is getting much, much tougher.
Who's turning up the heat competitively? Is it the usual suspects?
It's the usual suspects, like Adidas and Puma, sure.
Yeah.
But it's more than that now. You've got Lululemon, which has really established itself as a major lifestyle competitor, arguably stealing high-margin apparel customers. And then, importantly, you have the fast growth of the Chinese company Intia. They're challenging Nike directly in China, which is, their second most important market globally.
Okay, and that financial health point you mentioned. What do we know about their current ability to handle this pressure? Are the cash reserves holding up? Is debt creeping up?
That's a bit of a black box right now, actually. We don't have specific, verifiable recent numbers for total debt or free cash flow from the very latest filings, so investors have to rely somewhat on that historical strength narrative. The real concern is that billion-dollar-plus drop in operating profit, that EBIT decline. That could absolutely start pressuring their financial flexibility later this year if these restructuring plans don't start showing some positive results soon.
Okay. So The fundamentals paint a picture of, frankly, severe stress and a lot riding on execution. Now we get the financial pain. How's the market reacting? Let's look at the stock chart, the technical picture, as of late September 2025.
Yeah, the charts definitely reflect that stress. Over the last 3 months, the stock's been trading roughly between $85 and $108 a share. Technically speaking, there seems to be strong support down in that $85 to $90 range. That's where buyers have tended to step in. But on the flip side, there's meaningful resistance up around $105 to $110. That level has been acting like a ceiling, capping any rallies.
What about momentum? Are indicators suggesting buyers might be starting to regain control, and is it still looking weak?
They still lean towards continued weakness, unfortunately. The 50-day moving average is currently below the 200-day moving average. For technical analysts, that's often seen as a classic, pretty powerful signal that the bearish trend could continue. Plus, the MCD indicator, another momentum tool, has been negative since way back in Q2 2025. That also supports a more neutral to bearish short-term outlook.
Okay, not exactly a picture of strength there. Let's turn to the analysts and the insiders. What was the street's reaction to that last earnings report, the one that showed the big declines?
Predictably, it was disappointment pretty much across the board. Several major brokers, Morgan Stanley, UBS among them, quickly lowered their price targets. Generally, they maintained a hold or neutral stance, though, which is interesting.
Interesting how.
Well, despite the immediate negative reaction and the weak technicals, the overall analyst sentiment snapshot as of September is still moderately bullish. It's something like 55% recommending buy, maybe 40% hold, and only about 5% saying sell. It suggests that many analysts are perhaps looking past the near-term pain and betting on that longer-term turnaround story.
Right, betting on the restructuring. And are the company executives signaling their own confidence? Are they buying shares in the open market?
Not really, no. Not in the open market. The recent insider activity we've seen is entirely routine stuff. We saw restricted stock grants in September 2025 to directors' names like Timothy Cook, Jorgen Vig Knudstorp, the Sunda Duckett were mentioned. That's standard compensation. We haven't seen any significant open market purchases lately that would signal strong insider belief that the stock is a bargain right now. And social media sentiment seems to echo that caution, lots of chatter about slowing growth and a lack of immediate positive catalysts.
Okay, so that brings us squarely to the future. If you're considering buying Nike now, you are essentially betting everything on a successful turnaround. So what are the key catalysts the market is watching? What might actually drive that change?
Well, in the very near term, you've got the usual seasonal potential lift from Black Friday and Cyber Monday. That's coming up November 29th. But I think the real focus for investors, the real meat, as you say, will be seeing actual proof that the cost-cutting measures are working. Management expects the early benefits from expense controls and supply chain optimization to start showing up in the next quarterly results.
Right, stabilizing those shrinking margins has got to be priority number one. And the next big data point is the Q3 earnings release. When's that due?
Scheduled for late December 2025. That report will be the first real chance for management to demonstrate that the restructuring isn't just costing money, but actually starting to gain some positive traction.
Okay, that's the near term. Looking further out, say into 2026 and beyond, what are the bigger drivers investors are hoping for?
The longer-term story really hinges entirely on the full, successful execution of that sport offense restructuring and the big overhaul of their direct-to-consumer channel. If, and it's an if, those initiatives deliver as planned, growth could potentially return quite quickly. We're also watching closely for any sustained material improvement in sales trends within China. That would be a huge boost to the outlook and might ease some of those geopolitical risk worries.
And are we seeing any big money managers placing bets on this turnaround yet? Any institutional shifts?
We are starting to see some movement, yes. Ferguson Wellman Capital Management, for example, they recently bought more shares. And perhaps more significantly, Cowen actually upgraded the stock in September 2025, moving it from hold up to buy. That signals renewed optimism from at least some corners of the institutional world about the future strategy.
And any market rumors swirling around? Anything else folks are watching?
Oh, there's always speculation. Persistent rumors about a potential rebound in demand over in China, maybe some strategic digital partnerships to expand that DTC reach even further, and talk about hitting key milestones and clearing out all that excess inventory they built up. Clearing that backlog would definitely help stabilize margins.
Okay, let's try and bring this all together then. We've looked at the, well, frankly, brutal fundamentals recently, the weak technical picture, and this heavy reliance on a future turnaround. So the big question, is Nike a good time to buy right now?
Based purely on the data we've reviewed, the overall rating we'd assign is maybe a moderate 5 out of 10. It really depends heavily on your risk tolerance and your investment time horizon. You have to be crystal clear about both.
Okay, a 5-10. What are the core components of that thesis, the positives and the negatives boiled down?
Right. The positives are still built on those foundational strengths. Nike is still a global brand leader. It has shown long-term financial robustness historically, and management is actively undertaking a major operational realignment focused on DTC. That could drive a successful turnaround, but the negatives are pretty stark and they're immediate. Those double-digit revenue and profit declines in FY 2025, they are severe. The restructuring itself carries significant execution risk. These things are hard to pull off, and it will absolutely require time, probably significant time, to show results. Plus, the near-term catalysts seem limited, which makes waiting feel risky.
So given that 5-10 rating and the risk profile, who is this stock potentially appropriate for right now? And who should probably stay away?
Okay, well, it's definitively not looking favorable for short-term trading. The negative technical momentum just limits any realistic near-term upside potential. It seems only appropriate, really, for the most patient long-term investor, someone who's genuinely willing to wait maybe 12 months, maybe 18 months, perhaps longer, for that operational turnaround to actually take effect. And critically, someone who can tolerate potentially significant drawdown risk, meaning the stock could fall further while they wait for proof that the strategy is working.
Got it. And just to summarize the major risks investors need to keep front of mind.
I'd say number one is execution risk. Management's plans might simply fail to reignite growth, especially in those key North American and China markets. Number two is ongoing margin pressure. That promotional environment isn't likely to disappear overnight. And number three is that high geopolitical and supply chain risk, largely due to the company's significant dependence on the China market for both sales and manufacturing.
Okay, so here's maybe a final thought for you, our listener, to consider as we wrap up. Given this heavy reliance on the sport offense realignment and some pretty intense cost-cutting efforts, how quickly can a giant global leader like Nike truly pivot? How fast can they adjust their massive brand image and complex supply chain to effectively fight back against intense competition, especially from nimbler players like Lululemon and those emerging Chinese brands, without maybe sacrificing the premium status of their own products and potentially making that margin problem even worse in the process? Something to think about.
And just a final crucial reminder, all the analysis we've discussed here today is strictly for research and educational purposes. It is absolutely not investment advice. Please always do your own homework and verify all data points directly from official company filings before making any financial decisions.
Thank you for joining us for this analysis of Nike. Tune in next time for more market insights right here on Investing Talk Podcast.